Hello, everybody. Welcome to our Wednesday evening webinar. Thank you for joining us for this evening's webinar. We are here with Your Money Landscape, Making Confident Money Decisions. Welcome, everybody. Thank you for joining us and for spending your Wednesday evening here. My name is Andrew Farrell. I am Patelco's financial well-being educator, and I'm here to introduce our guest speaker, our webinar, and all the fun stuff that we have in store for you guys this evening. So before I get started, just wanted to review some of our webinar tidbits here. We are going to have myself looking at the Q&A today. We have that Q&A section, and we also have the chat. You can use your chat for commenting, discussing amongst yourself. We actually have Edgar Nunez, who is a community engagement specialist with Patelco. He will be in the chat monitoring that for you all. And then if you have any questions for our guest presenter, you can use the Q&A for that, and I will be fielding those. And if we have some time at the end of today's webinar, we will use some of those Q&A questions to ask our guest presenter. Everybody who is registered will be receiving a recording of tonight's presentation. We'll have that probably to you guys' inbox by the beginning of next week, so keep your eye peeled for that. It'll have a YouTube link to where you can go back and rewatch all of the wonderful goodness that we're going to be talking about this evening. And also, as usual, we're going to have 3 attendees randomly selected to receive a $25 Amazon gift card. So keep your eyes peeled for that as well. We will have those emails sent out by the end of this week. So by Friday morning, early afternoonish, if you do get an email from Patelco Credit Union webinar saying, congratulations, here's a $25 gift card to Amazon, that is not a scam. That is actually us as a thank you for tuning in for our webinar this evening. If you have any questions or anything like that for the presenter, we also have the email for that as well. It's hello@thebrandsandbands.com. We'll have that sent to you guys in the chat as well. But I would like to introduce the webinar that we have this evening. So this is the first of a 2-part webinar series with our guest presenter. Part 1 is, like I said, Your Money Landscape, Making Confident Money Decisions. So this session is going to focus on grounding you and where you currently are right now in your financial space. We're going to talk about grounding financially and emotionally. We'll walk through today's overall kind of economic landscape, how to build a personal savings mix, and how to understand your own risk tolerance. We're also going to explore emergency savings as both a safety net and a long-term planning tool. And we're going to help you make clearer, more confident money decisions. And I'm super, super excited about our guest presenter this evening. We are joined by Nadia Vanderhall. So Nadia is a financial planner and educator who blends real-life experiences with clear, human-centered money guidance. She is the founder of the Brands and Bands Strategy Group, and she helps people understand their finances, build plans that actually fit how they live, and make confident money decisions rooted in their values. Nadia has been featured in outlets like Fast Company and USA Today, and she is known for making financial topics feel approachable, practical, and grounded in real life and where you currently are. So with that all being said, Nadia, take it away.
Hello, everyone. That was a good opening, Drew. Hopefully, everyone is having a good night tonight, or is night on my side of the world. No, on the East Coast. So let's go ahead and get started. Let's get this pulled up. Hit share. Oh, great. Let's see. Is it share? Is it showing my?
Right now, Nadia, we can see the whole thing, so I can see the next slides and all that good stuff.
Yeah, I hate that. I hate that. I'm sorry.
No worries at all.
Yeah.
Beautiful.
All right, so that's the one I needed. Okay, cool. All right. So, worry. I wish. Nope. Oh, great. All right, so let's go ahead and get started. So we are talking about understanding your money landscape, how to make confident decisions in a very interesting world. So before we start, I want to do a little bit of a pulse check. So when you think about where your finances right now, what instantly comes to mind? Are you feeling stressed? Or are you feeling uncertain or working on it? And are you feeling okay? I don't know if I could see the chat. Wish I could. we go. Wish I could see the chat.
We've got a couple okays, a couple uncertains. Someone put
Okay, uncertain.
need
There
more
we
dollar
go.
bag sign, stressed, panic, stressed.
Listen, right now it's a combination of all. I'm surprised no one said all of the above, but that's okay. So let's get into the next one. I already had a good introduction, so why should I go through that? One of the things that I want to add, though, is that I have a background in financial services. So I'm not going to speak jargon to you. I'm going to speak human to you because right now, people need to hear a sound of money that relates to them. I understand both sides of the coin. So all of the accolades are great, but the application that we're going to get from this is what's going to be key for me. I have is about alignment. One of the things that I love to talk about is your understanding your financial GPS. Because when you think about it, if you're going from point A to point B, you go and pull out Waze, you go out and pull out your Apple Maps or whatever, and you plug in where you currently are to where you want to go. And oftentimes, that's how I want us to start looking at how money is right now. We had this envision of what our American dream looked like, and it's looking a little interesting right now. But the thing about it is that if you see a detour coming ahead, what do? Do you determine if you're going to stay that course or are you going to go ahead and pivot around? That goes into the three-part framework that we're going to talk about tonight. The first one is understanding the pulse of where you are. Not necessarily where you are with money when it comes to the economic side, but where you are with money when it comes to the emotional side. We'll into that a little bit later on. But it's about understanding where you are now. And then whenever you understand where you are, we're going to go into part two, which is understanding how to move in your goals this season, where we are economically as well as emotionally, naming it, but also knowing how to our positioning or our options to go. The third one is your pivot. So within all of the melting pot, the gumbo, what's going on, how can we pivot when things look a little unpicturesque of how we envision our money? That goes back to my analogy around utilizing the GPS, because one move that we can make from this presentation is more of a compound interest than we would see of us doing doom stroll. I know I am known for strolling at night, and I know right now that you probably are feeling that you might just it's all a lot right now. So the thing that I want to take for you to take away from this presentation is to get one key goal from it and have action steps on how to go about it within the next 30 days. Hopefully that's what you're anticipating and not just getting talked to, but talked with. All right. So this is two quotes or two stats, but your money. 77% of Americans say that they have a significant source of stress right now. And I'm sure that you are feeling that way because we talked about that in the first slide and getting a little bit of conversation. But on the other side of it, 4 in 10 adults right now say that they can't handle a $400 unexpected expense without borrowing money, swiping it on a credit card, or selling something. The reason why I wanted to give these two stacks is not to make you, I say stats, stacks, I'm Southern, so apologize, that it's not to make you feel bad, but to make you feel less alone. Because right now you can see headlines on things and then see a different type of headline when you open up your bank app. But this session is this because I want us to not only understand our financial stress and name it, but also know how to go about doing things differently and unpredictable situations. So your presence is not necessarily just for you something to do for the next hour, but for you to pull one thing to know another thing about going forward with your money. So before we get into all of that, your intention is how you see the plan for your money, but the insights, the bank statements, the credit card statements allows you to position it. And while you can set a plan, things can change. Money can change, goals can change, interest rates can change, inflation can change. But reshaping your philosophy is what's going to allow you to see in uncertainty how to stick together. So I have 4 pillars on this slide that I want to call out. The first one is the intention. Intention is pretty much knowing your why. And beyond just, I want to be wealthy, being intentional and being able to name it and call it out in the clear. Insights is your self-knowledge, not necessarily what you see on headlines, but what you know internally when it comes to your money, being honest and understanding your capacity. This third one is your allocation. I'm sure in some way that you have heard allocation being sold, and it's like, oh my gosh, I don't know what that means. But giving every dollar a job, you surely have heard of that, but also giving it a job description. And we're going to talk about the jobs that they could have in a sense, but how to give them a description and being able to turn the insight and intention into a way to implement. And then one of my favorite quotes is be firm in your intention, but flexible in your implementation. And being flexible and being focused is what's going to keep you sane during the unprecedentedness that we're going through. So this one has a couple layers worth calling out. One, knowing yourself and your money habits and your intentional triggers in your life stage. The second one is understanding your capacity. Capacity is going to be a word that I use a lot in this conversation, but it's about understanding what you have for each month and aligning to what you want in the future. And everything's going to happen over time, and it's like a different type of compound interest. So I love to say, let's name a thing of what's going on and what is it doing for us, not necessarily to us, as I call out. Is that right now you're hearing everyone telling you you need to save this amount of money, you need to have these different tools, you need to do certain things. But a lot of financial presentations that I've noticed skip this one thing, acknowledging where we are in the moment and where we're living in and how to actually move to building a plan besides just pretending things are not going on. You have inflation, we have interest rates, we have job market uncertainty. But one thing that's certain that you are still doing good with your money, no matter if you need how much money you need. Unpredictability can have people doing one of four of all things: grabbing money tight, meaning holding things and not contributing towards your goals. And my mom says this thing, and I'm not a mother's girl, but that if we hold things so tight to what we have, what can good can come in? It is what it is. The next one is freeze. Not like I like the little thing where you freeze tag with kids. Is that you can have something called analysis paralysis, where it's too many variables going on. And how I love to say is that I'm overstimulated, and when you're overstimulated, sometimes you want to freeze. Another one could be out of sight, out of mind, meaning you ignore it, you check out. You disengage or you decenter entirely because it's becoming too much and stressing you out. The fourth one is decision fatigue. Right now, you don't know if you are having to think about what I have to cook for dinner. How can I start saving? How can I start investing in stock market? Or how can I pay this bill? Too many uncertain variables can wear down your brain, wear down your energy, and also wear down your wallet. So we have to figure out how to move from inaction to being actionable. Money is more than just math in your banking app. If you're feeling anxious, ashamed, overwhelmed, when you hear the topic of money, that is a common analogy that we're noticing right now. It's something called the consumer sentiment report. You probably have heard about that. That's just how are people feeling about money. And while the stats will confirm that people are feeling a little bit of a combination, but one of the things that I want to add to the whole behavior finance aspect of it is that the element of compound interest doesn't just work for how you're saving, it's working with against showing how things can be depleting. And the thing around your money story, you probably heard about an origin story or behavior finance, is that if you have heard as you were growing up that money was scarce, secret, or you didn't really have too much resources, that origin story of your money can show how you operate to optimize your money over time, and it weighs in. And honestly, right now, with seeing the stroll, seeing a lot of things going on, you don't have to necessarily feel confident or calm. I'm going to go ahead and say that now because everyone's telling you to be calm. But if your check comes in and everything checks out and you're left with a different amount than what you envision, that energy is not going to be comfort, calm, or confident. But you can still feel what you feel, but still make good financial steps no matter what's going on in your sanity. So it's about understanding one clear action move is more than doing a bigger action move. So when we understand the small, we're able to scale. I have this thing I love to say: the scale is the start, and this is showing that money is not just necessarily math. It's how we feel about ourselves and how we feel about our situation. Okay, now to the charts, but I'm gonna talk through the charts and not make it overbearing because when you hear about people telling you or suggesting to you to save money, it's more than just opening a savings account and just moving money there. This picture that we're going to paint right here and going forward is talking about five distinct types of savings, meaning the timelines, the rules, and how to align beyond the common thing that you probably have searched on Google or searched on ChatGPT or searched anywhere else. Am I saving enough? Versus a better question, am I saving in the right place for the right amount of time? So one thing I'm calling out first is emergency savings. You probably have heard that right now. But one thing I want to do is rename the thing. Instead of having it emergency savings, let's call it opportunity savings. Meaning, with how would you need it if you were to get laid off or a hospital bill or anything come out? You will need it right then, more than likely, until things align, and there's no penalties or any restrictions. Then there's something called short-term liquid savings. So if you're saving in a sinking fund or regular savings or regular savings, that you'll probably need that around 12 months in a year, especially for Christmas. Then you need that access in like a high yield savings or yield it savings or even a money market account. But then we have something called a medium term timed, say that five times fast, savings, which is if you're looking at your calendar, is it 1 to 5 years out? This could be for something like a car, a home down payment, renovation if you already have a home, education if you have your pre-rich little friends. You're probably looking at 1 to 5 years down. But when it comes to having the access to this money, it's going to be restrictions such as if it's a CD or if it's a tiered savings, 529 or anything like that. Long-term savings, many of you know what this one could be. This is retirement or any account that is kind of tiered to that. This is wealth that you're building for not only now your family, but intergenerational wealth, which is 5 plus down the years down the line. It's less liquid. We have the CDs, the 401ks, the pension contributions, the typical run of the mill that we hear about money. Then investing is savings. These are like growth savings accounts, money, but they are coming with the market risk. When your timeline is long, but your risk tolerance is a little bit more important. So this is more so beyond the 5 years. This is going to the long term, beyond like 10 and 20 years, and it's market dependent, not FDIC approved. This could look a little different depending on the capacity of what you're doing. So now that we went through those five, I want to add a little bit more context to it. So you hear about saving. Let's talk about the aspect of life planning when it comes to savings. So they're not the same. So the same way that I view savings when I was 26 is not going to be the same way I view savings as 45. And it's also not going to be the same way whenever I do get 58. The cookie cutter aspect when it comes to talking about financial planning, personal finance, or even saving or any money goals will be like all Gen Z or what Gen Z, millennial, boomer, or whatever. But you have to realize it's another layered approach because the 26-year-old Nadia had things different than a 26-year-old whoever at this time because of the time capacity. Things are a little bit different than a couple years ago. But it's three different elements to keep in mind when it comes to life stage planning when saving. Is that early in your career, regardless if you're just graduating college to go out into the real world, or graduating high school to go to the real world, that you're here to start saving, to start investing. But the thing that's not layered down is how does that look for you with this new salary? How does it look for you understanding a whole new world like Aladdin? It's time sensitive. So you can hear about putting your opportunity or emergency fund first, but you're like, I can't say 3 to 6 months savings. We'll talk about that a little bit differently in a minute. But you can also hear about mid career growing families, or what I love to call the sandwich generation. If you are a millennial, Gen Z, X, or even some Gen Z, you are not only taking care of your own money goals, you probably have kids and you probably are taking care of your parents. So you're parenting everyone, including yourself, and you're saving for everyone, including yourself. I can't see the comments, but I'm sure some people feel this one a lot. But the thing that I want to call out is that I want you to protect not only your retirement contributions, your savings goals, because budgets are tight and a lot of different elements that are not in your budget are pulling at you right now. But when it comes to saving, you have to understand how to bob and weave, especially in this part of life. And then retirement and pre-retirement. So you moving away from wealth building to wealth preservation, meaning you're preserving wealth and growing wealth. You're having the elements like security timing, withdrawal, healthcare bridges, meaning you're moving from traditional healthcare over to Medicaid. You're trying to figure out what's covered, what's not. But I'm noticing now that a lot of those that are in retirement stages are starting to pull their emergency funds down, as well as it's not trying to touch their 401k, which I understand, but it is what it is. But those three elements of life planning goes into not only living life or life in, but how does it handle or align to how we money and then how we saving and investing. A quick question: what or if I would have is what's one savings goal that if you make consistent progress on it that will give you a peace of mind? That's something to think about. Because in all different elements, I would think back in my early career, it is just me understanding my budget to start saving. For me, mid career will be how can I find a balance that works with pre-retirement, retirement. What does saving look like for me? Is it just me having enough income stream to handle inflation? So it's what's going to give you a peace of mind to match the mindset of which you're at, where you're at. When it comes to saving, I love adding the pyramid element, and I flipped it a little differently. So liquidity is at the bottom. The reason why I'm bringing this into the conversation here is because liquidity is going to be your opportunity or emergency savings. Is that when can I get that money if I need it? If I am laid off today, how can I access that money? Can it? It has to be what it have to be fully liquid, meaning cash, meaning you can access it. It's no penalties, not exposed to the stock market, and you can get it within 24 to 48 hours. As you go up the pyramid, it's going to get a little bit more interesting to get that liquid for the returns of it all. Then we're going over to safety. Question to ask yourself is this money protected? FDIC assured account up to 250,000 per, you know the jargon. But it's if the money is not FDIC approved or insured, can it still grow consistently and significantly? Knowing the bucket that you're of water that you're carrying and how to carry it is very key. And growth, of course, is this money working for me? Emergency savings might not necessarily, the emergency savings prioritize safety and liquidity over growth. Long term, as well as investment savings, prioritize growth, but you have to look at the time horizon to ride out the short term swings. And right now in the stock market, we're going through some interesting swings, but it's about understanding, like I said, the bucket that you have versus the overall pond that you have right there or you're envisioning. So you have to understand which buckets are going to carry to what weight carries with what with each bucket, but also how do I switch between buckets to understand where am I at within my journey to get from where I am to what I wish to go. Another chart. So I know we talked about buckets, but we have to understand the right bucket at the right time. Let's do this so I can see at the right time. So beyond having five savings types, if you know what you're reaching for of the bucket, you're able to understand, am I reaching for the wrong bucket? And that wrong bucket can create domino effects like tax penalties, you losing some growth, and even the whole mindset aspect of did I take out of my 401k too early enough? How am I timing the market when you should be having time in the market? I like to quote Warren Buffett sometimes, but here's the way that I want you to utilize it: is that if this expense is this, use this bucket. So if you have something planned like holiday travel, insurance premium coming up in the next 6 to 12 months, you're going to look to your liquid, short-term liquid savings that you have a set aside for this set thing. The killing thing about calling out is that if you are to use from that bucket or pour from that bucket, how will you refill it later? When it comes to anything such as a long-term, short-term savings or even emergency savings, if you were to use from it, how are you going to refill that? That is a conversation that's not really talked about when it comes to savings. Also, let's pull another one is that if you have a specific goal, 1 to 5 years down the line, you were wanting to buy a house in the next year or 5 years. Okay, so what medium term savings goal or savings account would allow me to know that goal, grow that goal, and go after that goal and use it when the time arrives. So you go and look at the timeline that you have, be flexible with it, but work backwards towards it. And the one that everyone envisions is retirement or a goal 5+ years down the line. This is going to be for long-term savings that you set it, you look at it, but you don't touch it. And every early withdrawal actually pulls more than you realize. It doesn't necessarily pull account value, but it pulls the growth. Each bucket is a tool. And the thing that I would love to call out is that you don't necessarily use a hammer when you need a screwdriver. And I know that you get those instructions from getting new furniture or anything, and it calls for a screwdriver, you're not going to use a hammer. So you wouldn't necessarily touch your retirement account if an HVAC is broke. And right now I have been seeing headlines calling that people are having to do that. And this is why I wanted to bring this element to it for you to say, I can go ahead and start putting something together into a regular savings account. So if the HVAC, something happens to that, I don't have to touch my retirement account. As your plan grows with your life. So going back to what we talked about a while ago about how you do money at 20, it's not going to be how you do money at 40. It's about understanding if you were to get married today, you're not only bringing in two wallets, two budgets, you're bringing in two habits. You're bringing in a set of goals. You're bringing in risk tolerance on how to work together. And the amount that little rich best friends cost to raise, from healthcare to childcare to school, yeah, that's another layer. But the thing that I would love to call out is that even though you have all of those variables coming, I still want you to find time to not only grow with what goes, but to review your money fold. Meaning, do an annual review, 1 hour, this yourself or with a professional or with your person, to ask yourself certain questions like, has anything changed? Do my money buckets or savings buckets still match my priorities? And if there's a gap, how can we fill the gap with the capacity that we have? But one of the things I wanted to call out is that you're not giving your annual review from an emotional side, but you're actually tapped in because your emotional risk tolerance can impact your financial risk tolerance. So it's about being intentional, but seeing that, hey, there is a gap. How can we do this within our capacity? And understanding your financial risk capacity is about understanding what can I afford to lose without derailing our plan. Maybe childcare costs a little bit more than what we envisioned because the thing went up. So how are we able to ebb and flow due to how the money is going, but also knowing that you can sit on both sides of the axis and knowing that you are in a real position, but there are options for you to still stay on the course. Okay. So let's see if we can have a couple of these. There's two questions that I have right now. It's a lot that we covered, but which savings type do you feel most confident about right now? Is it your emergency savings that you have a cushion and you know how to use it? Is it your short-term savings, meaning that you are tracking and knowing what's coming up with your expenses, medium term, or goal-based savings, meaning you have a specific goal that you're building towards? Long term, which is retirement, or honestly, none of them yet. And if this is you, it's a lot of people right now. The other question is, what's the biggest barrier to saving right now? Let's see, I can peep in the chat. Long term, is your feeling? Too much. Oh gosh, I'm sorry about the feedback. Is the feedback still going on? Okay. Can everyone still hear me?
Yeah, I can hear you just fine. I think the feedback might have been just an error on that person's device because looks like the feedback on my end is totally fine.
Okay. All right. Thank you. It looks like we have a feedback and you can hear me fine. Thank you. One that I call out is emergency, not enough after expenses. That is a rarity. Oh, this is a good one. Underemployment. That is a lot right now. Yeah, that's all I can say is that even if you're feeling like to call out for, I believe, Marcy, that Marcy said it's not enough after expenses. Yeah, that you know you need to save for a long-term emergency fund or whatever, but finding the capacity into how you start and scale. And actually, we're going to talk about that in the next section of this presentation. Hopefully, I'm doing good on time. All right. So I'm glad that you said you brought that up. I want you to still start somewhere, but also start now. This is the power of the pivot. So the going back to what Marcy said about having 3 to 6 months of expenses, you'll hear people give you that advice when it comes to emergency savings. But here's what people don't really conversate about or get it correct is that's the starting point that they usually give generically. But for most people, if they hear that you need to have 3 or 6 months or even 12 months of emergency savings, you're like, I can't really do that, but it's not necessarily to build everything at once. So going back to that whole caveat that I have around starting with 500 as a savings goal, not necessarily saying I have to start with the $500. No, if I have $400 I'm saving towards, how is it going to break down into my budget? Moving from zero to saving something is the key. It's not necessarily the number, but to know it how to keep going. So here's how this, and I did not think that I was going to look and see Marcy's comment, but when it comes to understanding how to actually build a savings account or a savings goal like emergency, the thing that you have to do is list out what does that look like for you. So if you're hearing, say, 3 to 6 months of expenses, let's make it a little bit more tangible. What is 1 month going to cost to live your life? So that could be your housing, your utilities, your groceries, transportation, even minimal debt payments, insurance. Then whenever you hear that number, you need to multiply that by your target amount of months. So let's just start at 1 month. That's the goal that we're starting with. Whenever you hear that, we're going to set a stage one of either $500, and then you're going to notice stage two is that full month of expenses. The reason why I wanted to start or to introduce that to people is because you're able to see early wins and build momentum as you go, inch by inch, until you achieve it. But the thing though, after you have opened up that account, list that account, whenever you naming that account, I know I put emergency fund, but we're gonna name it or stick with opportunity fund. This is going to give you enough friction to stay with it because if you name it, you're able to claim it. I know that sounds like some kind of generic thing, but going back to money is not just math. Money is energy, and the energy that we have around it is what's going to keep going towards it. And automate a small transfer. Oftentimes you hear people talking about emergency fund or any type of savings fund, you're hearing the number 250, 500, and you're probably looking at your budget like, I cannot handle it. Start with something as small as $10, $25 every paid day, $25 every paid period. Adding up will come to $650 a year. What is something that a statistic that we talked about early on in this presentation that most people can't afford a $400 expense. So if you're able to save up to 650 in a year, you're able to handle a stage one situation. And then the automation of doing so will allow it to be like a savings bill that you're prepaying for the future to help you. You don't have to remember, it automatically just happens. So that's the reason why I wanted to call that out, is the fact that people will tell you that Come on. People will tell you that this was to play with me. I'm sorry. People will tell you that you need to save a large amount to see growth, but you can start with 25, 10, and put it over into an account and watch it grow over time and still hit that month 500 savings goal, a month savings goal, or whatever. It's about building the consistency within your capacity. Now let's go to the next slide. One of the things that I've seen with talking with people, showing online, is that when you hear I need to save, it's like, how can I figure out my which one first, the emergency fund or the retirement fund? That's one of the common things to say, which should I focus on? And I want to help you with something I call the 80-20 ratio, meaning whatever you're noticing that you have within your capacity, being the cash to flow, you can put 80% towards one going strong and 20% towards the other. But the thing to call out is that your emergency fund protects your retirement savings, because without it, if something was to come up, you're not necessarily having to pull from your retirement savings. And if you're having to do so, I'm not going to sit here and call it bad. I'm just going to call it that we're going to have to redirect it a little bit, because building one savings layer protects everything else. So if you're having some in an opportunity fund or emergency fund, that's going to protect your growth in your retirement fund. And the sequence that works best is that starting at stage one emergency fund or the bottom of the pyramid is going to allow you to build the growth and as well as the liquidity and stability that you will need. I don't, it's the reason why I'm stating it like that is because I want us to not seem rigid, but it's resourceful to match the growth or the capacity that we have within our savings and that we have within our wallets. Because the exception I want to call out is that if your employer has matched with your retirement contributions as part of your compensation, the thing is that I want you to still to capture that match and then move on to your emergency fund. But the thing that I said recently is that I want you to do 1% better. What do I mean by that? Is that if you're looking at your employer, say this is the match that we're going to do up to a certain amount, and you go look at your budget and you determine, hey, I can't match dollar for dollar right now. Maybe change for change. If you can do 1% better than what your were doing previously, maybe it's zero. If you move from 0 to 1%, that's pushing you closer to 100% than you were initially. And maybe it's not a full 1%, maybe it's a half. And then you're able to go back and revisit this after a while to see the growth within your retirement account, the growth within your savings, to say maybe I can push it a little bit up to 1% during your annual review of your paycheck and as well as your growth, your savings goals. Okay. That one move that is all that we need right now. So I know that we've covered a lot, from post to proposition to pivot, but I want to make sure that you leave with something, not necessarily a laundry list, but a specific thing that you could do. Here's a couple options that you could do. Within the pivot, it doesn't necessarily have to be elite. It could be something as small as setting up $25 automatic transfers into us as a pivot. Logging into that retirement account that you've forgotten about or you were scared to look at. Logging in is a pivot. Let's see, calculating your monthly essentials for the first time is a pivot. The scale is in the start. I'd rather you do some than none, and you don't have to fix everything. You just have to begin. The next one is that you can look at everything that we covered today. I'm sure they're going to send this presentation out to you, align it to your life stage, and see what your savings looks like in your risk picture, the risk tolerance, all that good jargon, and say, my biggest stressor is this, but here's what I'm going to pull from all of that content to make context into my currency. Then I want you to be specific, not necessarily say, I'm going to save some more. I want you to be intentional. I'm going to set up $50 or $25 savings into a specific account on the 1st and the 15th, starting this Friday. That's commitment, being specific, but also going beyond the intentional, that general intentional thing that you will hear, like beyond just saying, I'm going to save. I'm going to do A, B, C, being intentional as well as insightful. All right. So the Q&A is the best part. This is where we go more in depth on specific things from the framework that we talked about, the pulse, the position, the pivot, and to know where you are and what your savings landscape will look like. So I'm going to see if we have any questions within the Q&A.
Yeah, nothing in the Q&A right now, but if anybody who is attending, if you have any questions for Nadia, you want to pop them either in the chat or in the Q&A. We have, it looks like about 10 or 15 minutes to do some questions. If anybody has anything you would like to ask, now is the time.
Please ask. See.
If anybody has questions and you want to, oh, we got someone to pop in here.
Thank
Suggestions on
you.
saving when you're on Social Security. So if you have like a fixed income or a limited income.
I'm glad that someone asked this question because I didn't want to throw my mother under the bus. But this is a question that she asked. One of the things that I would tell you is that I'm glad that you're asking this question, but I want you to go and to look to see if out of the subscriptions that you have right now, if you have any, to see if you can call and negotiate any of that down for it to be lower, and then anything that you're saving per month. So say for instance, if you go and call the cable company and the cable company able to get a promo for you and you're able to save $20, $30 a month, that you're able to take that $30 from what you're saving and use it towards your savings. That is one key thing that I would say that will be a good way for you to start saving, is to look within your expenses now to see what savings could you pull from or utilize. And honestly, if even if it's not $30, see where you can find $5. I talked about with a publication a while ago around saving a couple of $1,000s within 100 days. And one of the things was that you'll pull an envelope and no, you'll write on a sticky note 1 to 100. And then when you'll write on each of the sticky notes, there'll be 100 sticky notes and you put it in a jar. Then every day you'll pull out a sticky note that will go towards that $100, or even if you were to do a different variation, and that was what you will transfer into your savings account each day. Now is that was a couple thousands of dollars, but even if you were to do something like that for $100, for $500, that would still set the intention around the insights of you knowing how much money that you have. But one that you can do, like I said at the top, was for you to go through your bills and expenses and to see what can you call and negotiate to get that down, and what you save, you save.
One thing I like to do, Nadia, is I shop at like discount grocery stores and things
Oh,
like that a
I
lot. So
love
every
that.
time on the receipt, when it says like you save this much today, actually put that in savings. Like it's not actually
Yes.
saving if you just spend it on the next thing that pops up. So I like
And
that suggestion.
yes, that is actually a good one. And I was thinking about that. I was like, I don't know. But yeah, it's if you're going shopping and you're seeing that you're saving 30%, move that 30%
Or even
or
over.
move it over. Yeah, it's about being intentional, because think about it. If you're going to the grocery store, I'm glad you brought that up, and you budgeted to spend $100 and you spent 70, what's
Mm,
happening to that next 30? You
yeah.
already earmarked it. Where is it going to go?
Yeah. Another question that popped in, any suggestions for someone close to retirement to grow
Mm,
money outside of just a traditional savings?
it's outside of traditional savings. Look to see if you can go ahead and do contributions towards catch up contributions. If you are within 5 years, you are at the max, or you're at that time where you can go. It is a book that I recommend called 5 Years Before Retirement. Oh, gory. And I'm trying to look at the same time. But yeah, looking to see what catch up contributions you can do to your 401k as well as to a IRA. If you have a Roth IRA, you can do contributions towards catching up. So I think right now for IRA, the contribution limitations for this year is 7,500, and then due to the fact that you're within that 5 year window, it actually goes up $1,000. So that's what I would recommend. I'm trying to find the book for you. That is a real good book. I'm actually know who the author is, but I can't remember her. What the to make sure I'm telling it right. Emily. Yeah. Yes, for the 5 years before you retire, by Emily Guy Biken. That's a very good book. But that's what I would say is to look to see what capacity that you have right now. Where are you saving at? Is it in just a savings account, a money market account, or 401k, IRA? Then determine what catch up capacity could you do. Could you contribute a little bit more? Could you move that money more than what you're doing? Where you are with your capacity, and how can you bump that up? And then what pockets will be for that account. One of the things I love to talk about when it comes to saving and investing for that later years of life or your golden era is to understand the income streams that you will see those savings accounts to be. So if, say, for instance, your 401k could be for your housing, your IRA could be for your health care or for utilities, a regular savings account or a yielded savings account could be towards travel. It's about understanding where you are, your goals, and then how can we align to those pockets. So hopefully that answers it. But that's what I will check out that book, see where your capacity is, where your current money is currently going, and then what could you do along that timeline that you have. So reverse engineering it in a way.
Beautiful. There's a couple other questions that have popped in about like retirement stuff, which we'll get to here in a second. But I did have what should be a pretty simple one to answer, and it's kind of a lead into what we have in 2 weeks as well. So I know in our presentation we're doing in a couple weeks, we'll be talking
Mm-hmm.
more about like actual types of savings products and things like
Yeah.
that. Someone did ask kind of a very base level, does it make
Mm-hmm.
more sense to put money in a money market rather than a regular savings account? And kind of what would be the pros and cons of the differences of those two?
I would I know a lot of people right now are against regular savings accounts. I love them. Here's why I say that. Hear me out. It's something called a split. I want you to keep at least a couple, dollars in your regular savings account. But I would love if you were to put money in a money market account. Here's why: as you're saved, you're paid more on the money market account. So I will suggest that you keep money in both pockets, that you put some money in your regular savings to keep just in case something comes up out the blue and you don't want to wait 24 to 48 hours for that transfer to happen, but also keep money in that money market account to grow as you store away your money. So as you're saving, you get paid. The more you pay, the more you save, the more you're paid with a yielded account like a money market account.
Beautiful.
Mm-hmm.
There are some questions that are coming through about the,
Keeping
I
coming.
guess, like retirement income and
Mm.
like what age to take it. So there's a couple
Ooh.
people asking about between like 62 and 67 when the government suggests what age you should start taking out, what penalties or adjustments you would need for like delaying the
Mm-hmm.
withdrawal of your Social Security and retirement. So if you can talk a little bit about like age range when you should start withdrawing and what you should consider when you're thinking about when you should start taking out retirement, that would be, I think, super helpful.
I know. That's a very good question. That's what I was anticipating when someone asked about that 5 year window. I knew this actually was coming. So going back to that 5 year window of retirement, and I know that right now they're telling you around 67, 68. But I also know the longer you wait, the greater the money that you can stand to see. When it comes to withdrawing, when you are 59 and a half in a day, that's when I will start really looking at how much you're withdrawing, what is it being used for, and how can you pace your pool? Meaning, am I going to look at 67, 68, 69, 70? I think the closer to you see the seven is the better you're going to see. I don't want to say heaven, but that was just, I like analogies. So I like puns too. But that's what I would suggest is that you look at where you currently are, what your options are you going to just be pulling from a 401k? Do you have an IRA? Or are you going to be making, that's why I have T. Are you going to make a way towards your Social Security? What are you pulling? How much are you pulling? And then how are you aligning? I don't want you pulling everything at once. I want you to say, okay, with I have an IRA, maybe I can start pulling it at 69, or I can start pulling it at 65, 69, 70. So you understanding the phasing of it all, of where you're pulling certain stuff from. So that's what I would suggest to not too close to getting out of regulation, but that's what I would suggest. I have to tear those lines. I remember that side of everything. I don't want compliance getting me, but that's what I would suggest that you look at that book. That book is golden. When I say you can find it on Libby and get the book for free. I'm all about free, but you will
What's the
look
book
to see.
title again, Nadia? I want to drop it in the chat.
Okay, let's see. It is the 5 years before you retire. Retirement planning when you need it the most.
Or you retire. And who's it by?
It is by Emily Guy, Guy Birkin. My
B
Birkin guy.
Berkin.
Mm-hmm.
Beautiful. I am dropping that in the chat for anyone who wants to reference this. The 5 Years
Mm-hmm.
Before You Retire by Emily Guy Birkin. An
Mm-hmm.
interesting question came through here. Let me see if I can find it again. So, how do we reconcile growing our retirement when interest rates for IRA products and retirement or products can sometimes actually be less than a standard basic savings or like standard basic money market rate?
Mm-hmm. And I'm sure this person is asking because they have noticed that the rates have gone down from where you
Mm-hmm.
initially opened it and you saw it at the heyday of the pandemic, and you're wondering what is going on. That's a common question that I get. Is right now that the Federal Reserve is making decisions on where the economy is right now. And when they move the federal interest rate down, that can cause the rate on savings products like money market accounts, high yield savings, or anything like that to go down. One of the things that I would suggest to people is to not necessarily chase the rate of the account, the APY, the annual percentage yield. I want you to chase the rate of how much you're saving. The reason why is because the same account that I had back in 2017 that was paying me 1.570 has grown when it was 4 plus on the APY, and it's still growing right now at 3 because it's about the amount that you're saving as well as what the APY is. So as you're noticing that it's coming down, I want you to still tap in with your savings rate, meaning how much you're saving, more so than the savings rate. I understand that if you're noticing that you got another email saying that the interest rate has gone down and you're like, I should just stop. But let's ask a question for a question. If I stop putting money in a money market account because it dropped from let's just say 4.0 down to 3.50, is that 3.50 still going to be more than that one or the 0.001% in the regular savings account? Yes. So that's what I would say. Don't chase the rate of the product, chase the rate of the pace that you're saving.
I like that. Good advice. Okay,
I
we've
knew that
got
was
just
coming.
we've got just a couple minutes left. So anybody whose questions we did not get to, I am going to drop the email that you can reach out to Nadia to in the chat right here. Hello at thebrandsandbands.com. You can copy and paste that. Also, someone asked about the website to get that book for free, libbyapp.com. Thank you, Jean, for dropping that in the chat as well. Libbyapp.com if you want to review that book. And then again, any questions we did not get to, hello at thebrandsandbands.com. That goes directly to Nadia. She's happy to answer any questions that we did not get through here. I am going to, before we wrap it up today, just want to remind everybody that we do have that survey that's going to pop up at the end of this webinar. If you wouldn't mind just taking a minute or two to fill that out, a couple questions would be very, very helpful to us. But we do, I talked about it at the beginning of this, have a second part to this in 2 weeks. So that'll be on May 27th. We'll have Nadia back for part two. A lot of the things that people have been asking for in our earlier webinars for the year in those surveys were kind of more like tactile planning skills. So what are the actual products and avenues that you can go down to, think about your long-term planning? And that's what a lot of part two is going to cover. So Nadia, did you want to take a minute or two to just kind of tease what we have coming up in a couple weeks?
The part that I wanted to tease about, and you actually did it, was that we're talking about where you are with your money landscape, but that's going back almost to that savings rate conversation that we had. Is that if you're understanding where you can put your money to grow over time, that even if certain things change, like the APY or the interest or anything like that, you're still going to notice growth. But it's about understanding where you are and how to grow still, regardless of how things change and ebb and flow. But that's the thing that I'm glad that we're doing this in two parts, is because it's like the baseline and then the growth line. It's the growth marker of what we're going to be seeing in part two.
Beautiful. Cannot wait for part two. All right. Well, with all that said, Nadia, thank you so much for spending your Wednesday evening with us. I know it's a little bit later on your end, so I
A
appreciate your
little bit.
flexibility. And everybody, thank you for joining us this evening. That is going to do it for our webinar this evening. Again, for Nadia, hello at thebrandsandbands.com. Go check out that book she recommended as well. Lots of good stuff in there. And we will see you all in 2 weeks for part two. Have a great rest of your evening, everybody. And thank you for joining us.
Bye.
Bye. Hey, you guys. Hope you liked that video. Thank you for watching. For more financial wellness information, go ahead and click here to subscribe and here to watch the next video. Thank you.